Hello everyone, so welcome to yet another video of your CMA mentor. I know it has been long since I posted any of the videos regarding the chapters or any of the subjects. So what am I thinking of now is to make you I think so you all are aware that institute has released a workbook for you all to practice before exams. So what am I thinking is to start a workbook series in which I'll solve the questions. I'll take a chapter, I'll solve the questions of that chapter given in the workbook of the institute, so that it will be easy for you when you go for a revision. Like if you have any issue in any of the questions, you'll automatically go through this video, so that if any doubts you can clear it in one instance. Okay, so today what I am going to start is with the chapter which is known as portfolio, which is one of the most important chapter and the most weighted chapter of CMA final in your SFM. So what I would suggest to you all is to initially start with this chapter in only for your practice or for starting, because it is a chapter which almost comes around 25-30 marks. Questions come around in your exams, so it is better to start with a chapter which has a major coverage. Okay, so today I'll be solving I don't think so the entire questions I'll be able to solve in one video. What I'll do is we'll start with we'll see how many questions we can solve in one video. So we are starting with once again I'm repeating, we are starting with workbook revision of paper number 14, that is strategic financial management, which the institute has recently released. So we are starting with the chapter portfolio. Okay, so let's begin in 1 2 3. Okay, so starting with illustration number 1, the question says Mercury Holdings Limited, an investment company, has investment in equity shares of a blue chip company. Following data is available. The risk-free rate is given, which is 10%. The expected rate of return on market portfolio, basically it is return on market, which is given, which is 16%. Market sensitivity index, basically, which means beta of equity is given is 1.50. Okay, so what does the question require is you have to firstly calculate the expected rate of return on the investment made in the security. So basically, how to calculate expected return? The formula is risk-free rate of return plus beta of equity into rate of return on market minus risk-free rate of return. So this is the basic formula for calculation of expected rate of return. Okay, so in the question, the beta of equity is given, which is 1.50. The risk on market is given 16. Okay, and the risk-free rate of return in the question it is given, which is 10%. Okay, so we'll just put this in the formula and the question will be solved. It will come to 19%. So this was an easy going question. Once you see, another time you don't need to see this question, you can just cut, so that in examination it will be easy for you to read only those questions which are important from exam point of view. Okay, going with the second part. The second part is important because these type of questions can come in MCQ. Okay, they'll twist and turn the words and give you, and you may get confused that what to calculate in it. So the second part is saying market risk premium you have to calculate and risk premium on security. So the question arises, what is market risk premium? So market risk premium is basically this part which we calculate, that is RM minus RF is referred to as market risk premium. Okay, so this you can easily calculate, it will be 6%. Okay, second part is you have to calculate risk premium on security. Now you'll ask me, ma'am, what is this risk premium on security? Risk premium on security is basically this part. Okay, so what I would suggest you is write in a notebook this formula. Okay, I'll just guide you how to do it. Make a separate notebook. In that you write this formula. Okay, then what does RF means, what does BE means, this you write at the end. Okay, what does RM means, you write these, what does these means. I think so you are aware of. This is risk free rate of return, this is beta on equity, this is rate of return on market. Okay, and you just make an arrow like this and write over here, this is referred to as market risk premium. Okay, and for this, like this, you make an arrow and you write over here, this is referred to as risk premium on security or security risk premium. You can even write refer to in the question, they can even ask you what is security risk premium. Okay, so that in exam it will be easy for you. Only you have to read this formula and you just once go through it. Okay, this is referred to as market risk premium, this is referred to as risk premium around security, and the questions will be easily solved. Okay, this was just a tip for you for exam purpose. Okay, the third part is, so this you can easily calculate. I think so you have already calculated over here, so this is the answer. The third one is important. The third one is comment on the nature of securities. So I think so you are aware of it. There are three types of portfolio. One is aggressive, the second one is defensive, and the third one is you can say hybrid, or you can say the combination of both. So major there are two. Aggressive portfolio is a portfolio where in easy language I am making you understand, when beta of security is greater than 1. This is aggressive portfolio. Defensive is when beta of security is less than 1. Or if I make you understand in layman terms, it can be when there is a higher risk in a portfolio, this is known as aggressive portfolio, and when there is a lower risk in a portfolio, this is referred to as defensive portfolio. Okay, so because here the beta was greater than 1, so this is an aggressive security, aggressive portfolio or aggressive security. Okay, because the question was asking the nature of security, so you have to write it is an aggressive security because the beta is greater than 1. Done? I hope you have understood this question. If any doubts, you can comment below on the in the comment box, and I'll give a solution for you for your answers. Okay. Okay, we are done with illustration 1. Proceeding with illustration 2. The second question is also easier one. Only the formula is to be applied and solved. The question will be solved. Okay. So the question is, from the following data, please compute the value of beta of security. Here you have to compute the beta of security. I think so you are very much aware that beta's formula is basically R. R is correlation coefficient between because here market standard deviation is given and one of securities standard deviation is given. So the formula will be the correlation between market and security into standard deviation of security by standard deviation of market. Okay. The second tip is, you can even write this formula in your notebook, and you can in a similar manner you can write what does beta means, what does RAM means, what does RA means, what does RM means. Okay, so that it will be easy for you during the examination. Only just you need to see the formulas and you need to solve the important questions. Okay, so in a similar manner they have just applied this formula and solved this question. So it is a important question, but as an irrelevant question if you are very much have a grip on portfolio chapter. Okay, so once you see this formula, learn this formula, this question is a less important question and a less irrelevant question. Okay, you can get this question in MCQ form. There is a high probability that institute give this question to you in an MCQ pattern. Okay, coming to illustration number 3. Mr. Sabjanta owns a stock portfolio equally invested in risk-free asset and 2 stocks. Basically, what does this mean? कि there are portfolio consists of 3 securities. One is risk free and there are 2 stocks. Suppose we are assuming one stock as stock A and the other as stock B. Okay, so they are saying that Mr. Subjanta is a person who has invested equally on all the 3 stocks. So if there are 3 stocks, so equally means what? 0.33 invested in all 3 stocks. We can say like equally means what? 1 by 3. You assume it that there are 3 stocks and equally it is invested. So we can even say it that it is 1 by 3. Okay, 3 stocks and equally invested. If you're not understanding, let me make you understand by another example. If there are 2 stocks A and B, equally invested means what? We take it like half is invested in it, half is invested in it. So we say 0.5 is invested in it, 0.5 is invested in it. So in a similar fashion, what am I telling you is, if there are 3 stocks, then what will we say? If the question says that equally invested, this means that 1 by 3 portion is invested in this, 1 by 3 portion is invested in this, 1 by 3 portion is invested in this. Okay. Now proceeding with the question, if one of the stocks has beta of 0.8, okay, it is saying that among these stocks, if we say suppose stock A has beta of 0.8 and the portfolio is a risky portfolio, means it is an aggressive portfolio. As the market, what must be the beta of other stock in the portfolio? Basically, they are asking here what will be the beta value. And you are aware the beta of risk-free portfolio is 0. Okay. So, we have to basically calculate the beta of stock B. So, this is a question. How will you calculate? Okay. So, let's see what they have done. Similar manner, they have assumed risk-free portfolio beta as 0. Beta of stock A they have assumed as 0.8. In a similar manner, we have also assumed. Okay. Then we have to calculate beta of stock B, which they have assumed as X. Okay. So, how to calculate beta of portfolio? Weighted weight into beta, weight of risk-free portfolio into beta of risk-free portfolio plus weight of A into beta of A plus weight of B, weight of B into beta of B. This will be beta of portfolio. Okay, so beta of weight of risk-free portfolio is 1 by 3, beta is 0. Weight of A is 1 by 3, beta is 0.8. And weight of B is 1.1 by 3 or beta is we have assumed as X. Okay, and because equally invested, so beta of portfolio is 1. Okay, just a minute. Proceeding with this question. So here, since the portfolio was an aggressive portfolio, as far as I remember, it was written over here somewhere. Beta as itna is a risky. As the market, this line is written now that, and the portfolio is risky as market. When it is written in these terms, this means that beta of the portfolio is always 1. Okay, so here beta of portfolio is 1. You solve it and X value will come to as let's solve only, so that if you face any issue, you see the solution and it will be helpful for you. So I'm solving it over here. 1 equals to 0 plus 0.8 by 3. Just a minute. 0.8 by 3. It comes to around 0.2667. We are taking up to 3 decimal points, or let us not take up to in decimals, because already this is also not in decimal. So we will take 0.8 by 3 plus 1 by 3x. So we are solving it. 1 minus 0.8 by 3 equals to 1 by 3x. So 3 minus 0.8 by 3 into 3. X comes to around 2.2. Okay, so I think so you are done with this question. Let me once again explain you this question. So basically the question had all the information except here you had to calculate beta of the other stock which we have assumed as B. Okay, and it was given that this person, the Sabjanta, Mr. Sabjanta, has invested equally on all three stocks. One was risk free, another was A, and the second one was B. We have assumed A and B, the two stocks. Okay, so we had to calculate basically the beta of stock B. Also, the question had this important line that the portfolio's beta is as risky as that of market, which means that the beta of portfolio is 1. Whenever this type of word comes in your question, you remember it, that this means that beta of stock portfolio is 1. So we just applied this formula and we just placed the values over here and solved it, and the value of X, which is beta of stock B, has come to as 0.2.2. Okay, we are done with this question as well. Proceeding with illustration number 4. Okay, the beta coefficient of Target Limited is 1.4. The company has been maintaining 8% growth rate. So there is a company which is known as Target Limited, which has beta of 1.4. Let us write it over here so that it will be easy. And the growth rate is given as 8%. Okay, 8%, that there is a growth in dividends and earnings. Okay, and the last dividend was paid as rupees 4, which means that D0 was rupees 4 per share. Okay, now return on GOI securities. Return on GOI security basically means that government securities, which is RF. RF is given as 10%, or we can write it as 0.10. Okay, and return on market portfolio is given as 15%. We can write it as 0.15. Okay, done. And the current market price of one share of Target Limited is 36. Basically, the market price per share is given, which is 36. So what you have to do is, the first part is, what will be the equilibrium price per share of the Target Limited? Basically, you have to calculate the price. So how to calculate the price? Firstly, you have to calculate KE, that is cost of equity. How will you calculate it? RF is given, RM is given, beta of security is given. So you can easily calculate RF plus RM minus RF into beta. So it comes to as 17%. Now to calculate the equilibrium price, I think so you are aware of this formula. There is a formula which is referred to as D0, that is initial dividend into 1 plus growth rate by KE, matlab cost of equity, minus G. So just give the one more tip. The third formula is this, which you can write it in your notebook and which will be easy going to solve the questions. Okay, so D0 is given, growth rate is given 8%, KE we have already calculated 17%, G is 8%. So the price comes to as 48. Okay, the second part, would you advise to purchase the share? So this is a very crucial thing because people don't understand the concept behind it. So when will you purchase a thing? Suppose I'm asking you a question, when will you purchase something? When the price is lower. Okay, suppose there are two markets. Okay, two vendors, there are two vendors. One is offering you a chocolate at rupees 10 and the other person is offering you the same chocolate at rupees 8. Whom will you prefer? You will prefer the person who is offering you the same chocolate at a lower price, right? So this is a basic concept of this. So basically the market price was given as 36, but the price which you calculated, which is referred to as equilibrium price, is 48. So what, according to you, what advice will you give to Target Limited? So let me answer you this question. The answer is, since the market price, the price, equilibrium price is, that is, we can also call it as fair price. The fair price is more than the market price. So we can say that because it is greater, market price is lower. so it is worth it to purchase the share. Okay, done. It is an important question. This question can independently come for I think so around 5-6 marks in your exam. You can see this question, so please don't leave this question and go. Solve it in a proper manner and understand the concept, and if you have any doubt you can ask me in the comment box below. Okay, this question, illustration 5, is a good question from exam point of view and a bit bigger questions as compared to the 4 questions we have solved above. Okay, so we are starting with illustration number 5. Let's buckle up, freshen up our mind, and then start this question. Okay, it is just an extended version of the question previously solved by us, that is illustration 4 I mean. Okay, so illustration number 5, I think so this is the last question we are solving for the day. Will come with the next video. I think so. How many questions are left? Let me see once. Illustration 6, 7, 8, 9, 10, 11, 12. Okay, there are 12 questions. So I think so in the next video we'll most probably complete this portfolio chapter, starting with illustration 5. Okay, an investor, Mr. Jagannath, whatever, we will say him GT. Okay, Mr. JT is holding 1000 shares of Superb and Unbelievable Memory Limited. It is a company. Mr. Jagannath JT is holding the shares of Superb and Unbelievable Memory Limited, that is 1000 shares. Okay, presently the rate of dividend paid by the company is 2 per share. Let's write, suppose it is JT, I am writing over here. He has 1000 shares of Unbelievable Company Limited, and the dividend which the company is presently paying, that is D0, is rupees 2 per share. Okay, and market price is given, which is at which it is sold, is 25 per share. Okay, in the market. However, several factors are likely to change during the course of the year as indicated below. Okay, so there are many factors which are going to change, which are given over here. So the existing risk-free rate is given. Market risk premium, I told you about. What does market risk premium means? It is basically RM minus RF. So see, can you see it over here? What I told you, if you write it that in the notebook, it will be easy for you to grasp the further questions. And in exam, if you see, do not panic. What does market risk premium means? So because you are very much aware of it. Okay, and beta value is given and growth rate is given. So with these 3 you can easily calculate KE, that is cost of equity, which I think so they have also calculated over here. Let's see in the solution. They have calculated over here RF, RM minus RF into beta. Okay, so it is coming as 20.40. So what am I saying you is, in a similar manner for the revised market, they have given the RF, RM minus RF or beta, you can calculate KE. Okay, so we have they have calculated over here, which comes to as 15%. Now proceeding, what we have to calculate actually in this question. Okay, what we have to calculate is, in the view of the above factors, please show whether the investor should buy, hold or sell the shares and why. Okay, nice question. So you have to basically, for this you have to calculate the price. Okay, in the previous questions how you calculated the price. Price will be the only factor with which you can compare it with the market price and give a conclusion that whether to buy the shares, hold the shares or sell the shares. When I think so you're very much aware, when the market is overvalued, we sell the share. I'm writing over here. When it is overvalued, we sell the shares. When it is undervalued, when value is undervalued, we buy the share. And if market price is equal to that fair price, then basically we hold the shares. Okay, this you can even write in that formula book so that it will be easy for you. Okay, so we have to calculate price. How will you calculate price? Similar formula, D0 1 plus G by KE minus G. KE already you have calculated over here. D0 it was given in the question, it was basically 2. Okay, 1 plus G, growth rate is given over here 5%. Okay, K you have calculated minus G. It comes to 13.63%, which is this price, that is P0, is basically less than market price. So it means that market is overvalued. Okay, since, or you can even write over here so that it will be easier. Since P0 is less than market price, so the market is overvalued. So what you will do, sell the shares. Now for the revised one, we are seeing D0 will be the same. 1 plus G is 9%, K we have calculated in 15%, and minus G is not 9%, which comes to 36.33. So since P0 over here is greater than market price, so the market is, market price is 25 and P0 is 36.33. Since market is lower, so market is undervalued. Okay, so what should he do? He should hold the shares, and if his pocket permits, he should purchase the more shares. Basically, you must write over here, he should buy shares. You must not write hold, because hold basically means when market price equals to P0. I'll write over here. Fair price, you not understand. This is the situation when we hold the shares. You must write over here, buy the shares. But what I would suggest, since institute has given this answer, you in exam you follow this pattern only. Okay, but the actual thing which I have mentioned over here is this. So you must follow this. Okay. This is more than enough for the day. I will proceed with further questions in the next video. I hope you like this video, and if any doubts, you can just comment below. I'll surely respond to your comments. So if you like this video, please hit a like, do subscribe and share with your friends. Thank you. And also I'm starting a mentorship session from I think so upcoming Monday, that is 7th of July. Those of you who want to join the mentorship session can directly contact me. I have shared the link on the Telegram channel, and also shared my number, so you can contact me for the mentorship program and the more details regarding it. So thank you, all the best, keep studying, and do like my videos if you like, and you can even comment what else do you need what else do you need my help. I'll post videos regarding that. If you have any doubts, you can even give individual questions if you have any doubt. I'll help you out with those questions by posting videos on YouTube. Okay, thank you. Bye.